The crypto crash in 2022 has been very severe, but the worry now is that it's going to spill volatility into more traditional asset classes, such as equity. And there are precedents for that. For example, Silver Thursday in 1980 spilled volatility from the silver market into equity. And we saw the same thing in the subprime crisis in 2007 and 2008. So in this video, we're going to look at the reasons behind the crypto sell-off, but also what contagion mechanisms there could be for it to spill volatility into other markets. So let's look at the crypto crash contagion in a bit more detail. So how big has the fall in cryptocurrency been? Well, here beside me, you can see the total market capitalization of the 20 largest cryptocurrencies added up over time. And you can see it peaked at just under $3 trillion in 2021, and that was towards the end of the year. However, since then, over a period of about 220 days, it's lost about 1.7 trillion of that value. So in other words, it's lost about 70% of its market capitalization. And if we look at individual cryptocurrencies, which you can see beside me here, we can see the peak to trough fall in some of the largest cryptocurrencies. So the two largest are Bitcoin, which peaked in November of 2021, and which is down now by about 70%. And the second biggest is Ethereum, which peaked on the same day, and that's down by even more, almost 80% as I make this video. And then for some of the smaller cryptocurrencies, such as Solana and Dogecoin, you can see that those are down by almost 90% or even more. Now, why did this happen? I think a lot of the reasons are the same as the reasons for the equity market sell-off, which I've done in a previous video. And the most important of those reasons is what's happening to inflation and also to interest rates and economic growth. In this top panel, you can see the value of Bitcoin when it's expressed in US dollars, and also Ethereum. Those are the two largest cryptocurrencies, where Bitcoin is in red and Ethereum is in blue. And the two coins have followed a very similar trajectory. In the panels beneath me here are three macroeconomic variables which are very relevant to the sell-off. The first one, of course, is inflation in the United States. And I've marked the point at which it really began to take off in March of 2021 in this first panel. Now at that point, it didn't really trigger a huge sell-off in either Bitcoin or Ethereum. However, you can see the rate of growth of those two certainly seemed to take a dent when inflation did spike. But then things seemed to recover, particularly for Ethereum, whereas for Bitcoin, it started to sell off and pretty much moved sideways until the next shock, and that's the dashed orange line which you can see here. And that's probably due to this panel, which is 1-year interest rates in the United States. Now, the Federal Reserve didn't start to raise interest rates until 2022, but in 2021, the 1-year interest rate started to increase rapidly in expectation that the Fed was going to raise interest rates. And the point at which it really started to accelerate is this dashed orange line. Notice how that occurs just before we saw the turning point for Ethereum and also for Bitcoin. So that was in November of 2021. And really, neither of the two cryptocurrencies has recovered since that acceleration in interest rates really took off. Then when the Fed actually did do its first hike in 2022 in March, again, there wasn't an immediate reaction, perhaps there was a small one, but then gradually as the policy rate has ground higher, you can see that that hasn't been great news for either of those cryptocurrencies, or any of the others for that matter. So this new regime in which we have higher interest rates, higher inflation, and also higher policy rates from the Federal Reserve and quantitative tightening as it shrinks its balance sheet is an environment which seems to be toxic for some risk assets, particularly spec tech, speculative technology companies which are profitless, and also cryptocurrencies. And here you can see the NASDAQ index, actually the tracker QQQ, and alongside it, the value of Bitcoin, both scaled to 100 in October of 2021. That was just before risky assets peaked in 2021. Notice how the two pretty much track each other on the way down, the only difference being one of degree. Bitcoin has sold off more than the NASDAQ, but of course it also rallied more than the NASDAQ. Now, some people have said that it's all Jerome Powell's fault. I think that's a little bit disingenuous. I think that it's certainly true that more restrictive monetary policy is not good for risky assets, But the Federal Reserve has to raise interest rates. It's got to get inflation under control, and it has to shrink its balance sheet from its $9 trillion currently. Now, that isn't a good look for things like cryptocurrency, spec tech, but that really isn't a concern of the Fed's. Its focus is going to be keeping inflation under control, and some of the collateral damage when it does that will be slower GDP growth and, of course, the collapse of these speculative assets. Now, some people have done very well out of the rapid growth of cryptocurrency, or you could reframe that as where are the clients' yachts. Hedge fund manager Jim Chanos was recently interviewed on Bloomberg's Odd Lots podcast. And his sentiment, which I agree with completely, is that one of the problems with cryptocurrency is that there's a whole ecosystem which has sprung up overnight to feed off retail investors and charge them very high fees. And the stunning statistic which he came up with was that retail investors, that's like you and I, are being charged about 60 times as much as what institutional investors are charged. Now, in any other market, that would be considered price gouging, and there'd be people up in arms about it. But for some reason in cryptocurrency, perhaps because the returns were so high, people just seemed to ignore those huge fees. But now that the cryptocurrency markets have pretty much collapsed, suddenly I think there'll be more focus on keeping fees low, just as there is for traditional finance. Now, cryptocurrency platforms can extract fees in many ways. One is an obvious trading fee, but another way to extract fees effectively is by lending money to your clients so that they can have leverage for their trades. For example, this piece of text is taken from the Kraken platform, and it talks about how you can borrow money from Kraken in order to boost the returns on your trades. Now, of course, leverage can be toxic. It can amplify your gains as well as your losses. But that's not the platform's problem, that's our problem. However, they can profit even if we don't by lending us this margin. Now, what they actually say on their website is that the rollover fees for margin are very low, and they quote a figure of 0.02% every 4 hours, which on the face of it seems pretty low. Now, maybe you don't use margin in your account 365 days a year, but if you did, what would it mean in terms of compounding? So 0.02% per 4 hours sounds fairly innocuous. If we convert that into 1 day, still it seems pretty cheap, 0.12%. However, if we convert it to an annual rate, suddenly it becomes really high. Now it's 55% per year. So in fact, this is a very cost-effective way for platforms like Kraken, but also other platforms, to make extra money. They're lending you money at very high interest rates. So all I'd say is keep an eye on those fees. Try to find them even if they do seem to be hidden. And do you really need margin once you've got an asset which has very high volatility anyway? I'd argue that you don't. If you've been burnt in the speculative tech wreck, but also in cryptocurrency, then why not consider learning more about risk management and diversification of your portfolio? You can do that as part of our online community, which is now managed on our website, PensionCraft.com. You also get access to lots of members-only videos, plus our Slack channel, where we also have a cryptocurrency channel. If you want to learn more about that, just click on the link beside me or in the description beneath me. Now, given all that easily available margin, one of the structural problems with many cryptocurrencies has been too much leverage. And the reason why that's a problem is that let's say that something triggers a market fall. It could be anything. But if, say, you have 3 times leverage, if the market falls by 10%, your portfolio and your investments will fall by 30%. Now, for some people, that'll just be unacceptable. Maybe they'll panic, and at that point, they'll close out their positions. Or perhaps they'll get a margin call, which they can't meet, and their position will be liquidated. For whatever reason, people might be forced to pull out money. Now, in traditional finance, if that's a fund, then the fund itself will be forced to sell its assets. And later on, we'll see how this analogy carries over into the cryptocurrency markets. But if there are forced sellers due to margin calls and people simply wanting to cut their risk, then you get this feedback loop such that people are selling as markets fall, there's more leverage which has to be unwound, and eventually markets enter this kind of death spiral. Another structural problem is due to a liquidity mismatch. So as before, we've got this problem with initial asset price falls, then the fund price falls due to leverage. Then we've got the problem with liquidation. People are pulling out their money, but then perhaps the fund can't sell assets. So traditionally, this would have been when you have a fund which contains illiquid assets, such as real estate or maybe high yield corporate bonds. People are pulling out their money, the fund can't sell assets quickly enough, so the only solution from the point of view of the fund manager is to halt redemptions. In other words, the fund is gated. Now, this usually makes people very angry, justifiably, because they can see the value of their assets falling very rapidly in value, but they can't pull out their money. So this is a direct result of being able to pull out your money quickly, but the fund manager and the assets it owns are not things that can be sold quickly in a crisis, hence the word liquidity mismatch. So the liquidity of the assets is much lower than the liquidity of the fund, and that's what leads to gating. Now that we understand the problems with leverage, but also liquidity mismatches, let's look at the casualties from this crypto sell-off so far. I think the first big casualty was Terra, which was an algorithmic stablecoin. The idea with a stablecoin is that instead of being very volatile, like Bitcoin and Ethereum, instead its value is pegged directly to the value of the dollar. So that for a long period of time here, you can see that the value of Terra did keep to its $1 peg very closely. But then on May the 9th, the peg broke, and very rapidly the value of Terra fell very dramatically, and now it's worth almost zero. Now in our podcast, Many Happy Returns, my co-host, Michael Pugh, and I went into this example in quite a bit of detail, so I won't dwell on it here, but if you do want to learn more about that crisis, then why not listen to that podcast episode? Now, personally, I dodged this bullet because Celsius didn't let me open an account with them, for which I'm grateful, but they've actually announced that they've gated their platform. Now, Celsius, if you're not familiar with it, gives you a way of generating yield with your cryptocurrency. So they take your cryptocurrency, which you hold with them, and they stake it in order to generate a yield. And that can be very high. So in excess of 10% in some cases, sometimes up to 20%. So it was a massive shock, as this was seen as one of the kind of safer platforms in order to do that yield farming. Now, the nice thing about blockchains is that they are completely transparent. And there was some really great detective work done by Mike Burgersberg, at least that's his Twitter handle, and also Yield Chad, so those are the two accounts on Twitter, where they actually looked at the Ethereum positions of Celsius's platform, and they actually broke down the holdings into percentages. Now, what was worrying about this was that a lot of the holdings were very illiquid, and if you cast your mind back, that's a problem if you've got a platform where people need to pull out their money quickly. Because if it's held in illiquid assets, that can cause a problem because of the liquidity mismatch. Now, the illiquidity in this case came from the amount of Ethereum which was staked in the form of stETH, or alternatively staked in the form of Ethereum 2, which has still not fully been rolled out. And that meant that these two investments would be inaccessible for at least a year. You can immediately see the problem. And Mike Burgersberg says that Celsius may already be technically insolvent. Now, in theory, the stETH, which was held by Celsius, was convertible 1-for-1. There was a peg with Ethereum. But then there was a very large sale of stETH by what some people call a whale, a very large trader, and that happened on May the 9th. And after that trade, you can see that the peg between stETH and Ethereum broke. And suddenly, the holdings of Celsius looked at risk, because if it couldn't convert its stETH back into Ethereum on a 1-for-1 basis, then it might have difficulty paying back clients' money if they pulled out of the Celsius platform. So what we have in this case is a classic liquidity mismatch. The Ethereum which they borrowed from users was then staked in a form which was illiquid and might not be able to be withdrawn for a year, so that if investors did start pulling out their money due to a lack of confidence, then Celsius simply couldn't sell assets quickly enough to give them their money back. And of course, the consequence was that they had to gate Celsius. Here's the apology that was posted on the Celsius website, and the platform says that the news is difficult, but we believe that our decision to pause withdrawals is the most responsible action we can take to protect our community. Perhaps a more responsible action would have been not to stake in the form of something which is illiquid. But still, the situation we find ourselves in now is that Celsius has been gated for about a week as I make this video, and it still hasn't removed that lock-in. Then on June the 17th, another staking platform, Babel Finance, also announced that it was effectively gating its platform. And they come up with some really great terminology, which I haven't heard before, which is conductive risk events. That's what they've suffered. I think that just means old-fashioned contagion. But they say that they're also facing unusual liquidity pressures, perhaps because their holdings are also illiquid. Now, as I make this video, redemptions and withdrawals from Babel Finance products are still suspended. In conclusion then, the spillover into traditional finance, at least for now, remains limited, and that's a relief to many people. All of the collateral damage so far seems to be inside the cryptocurrency ecosystem. If there was going to be contagion, it would probably come from funds which held a combination of cryptocurrency alongside their more traditional investments. And that way, if they had got illiquid investments in cryptocurrency and they had margin calls or potentially had redemptions, then they'd be forced to sell their liquid assets, which would be their equity and their bonds. So that kind of cross-asset fund would be the gateway from one asset class to another. But as far as I can see, there isn't a large fund which is in that category. The second point, which is critical for us as investors, is that risk management is really important. In a bull market, if you use leverage, it feels as if you're untouchable and you feel like a genius. However, when markets turn south, which they inevitably do, particularly after a huge risk rally, then leverage can suddenly wipe out your gains. And then eventually, if you had margin, it could even wipe you out completely. So many people are now learning their lesson, which is that risk management is important. And you can get that via diversification, but also not getting leverage, which most people simply don't need. Another point is that trading is not the same as investing. Investing always starts off with a long-term mindset, where you just have reasonable returns for a very long period of time. Trading, on the other hand, tries to shoot out the lights with huge 10 times, 20 times, 100 times returns. And that's simply not sustainable. And if you do get that kind of return, you must be taking a very high risk. And then you could eventually be wiped out. And most people simply don't need that level of risk. So investing is what works long term for most people. And that's why we talk about it on our channel. And finally, a word of warning, I think, which is that this regime is just starting. Quantitative tightening has literally just begun. The Fed's interest rate increases have also just begun. So I think this is going to be around for a while, and it's going to be difficult for cryptocurrency, but also unprofitable companies to prosper in that kind of environment. So if you are buying the dip, I just say temper it with the understanding that this might be a new regime and it might be around for a long period of time. So the good news, at least for now, is that these problems do remain encapsulated to a few cryptocurrency platforms. But I think that's cold comfort to people who've got a large amount of cryptocurrency exposure. But if something good does come out of this, it'll be that all of us have a stricter discipline when it comes to risk management, but also keeping our fees low and also diversifying as much as possible. Those are universal rules to all investors. Now, don't forget our offer. If you want to learn about cryptocurrency, we have cryptocurrency investors as part of our community, and there's a Slack channel all about it. And don't forget our offer. You can go to PensionCraft.com to learn more about joining our community. And there'll be a link beside me and in the description beneath me, so you can do that. And as always, thank you for listening.